Welcome back. You're tuning in to Financial Fitness Northwest live on 1150 KKNW, where we help you navigate the mortgage and real estate market with expert advice from knowledgeable and trustworthy industry professionals. And now in studio, we have Gary Cassill, owner and chief financial officer of Mountaintop Advisors. Gary has been helping clients build and retain their wealth in tax-advantaged ways since 1983. He helped his clients invest prudently and helped protect them from losses when he owned his own insurance agency. And he took extensive extra classes to earn his certified insurance counselor designation to be of more value to his clients. Gary has twice been voted Best Financial Advisor by the readers of Auburn Reporter. He also supports the business community in Puget Sound by being an active member and ambassador for the Auburn Chamber of Commerce since 1998. His business was recognized by King County as a business in the green for its ambitious efforts to reduce waste, recycle, and buy recycled products. Gary lives in the Lake Tapps area with his wife of 25 years, Ellen, and he enjoys water skiing in the morning and getting as much top time as his favorite ski areas in the Northwest. So welcome, Gary. Glad to have you.
Yay, thank you.
So you're a skier, snow and water.
Yes. Yes.
I like that.
Me
Both
too.
cover both bases.
Yeah, that's awesome.
Do you usually ski at Crystal then down that way, or?
Usually up at Alpental because it's so much faster and easier to go up during the week.
Yeah.
Oh, yeah.
A couple of nights a week.
Night skiing up there. Yeah. That's
Nice.
fun.
I remember those days.
I know.
I might ski again when my kids, can take care of themselves.
Now I go skiing with my kids
Yeah.
as adults.
There you go. Fun. Well, so we're really excited to have you on the show and share some tips on financing for us. So right now, rates are at their 30-year historic low. So how does that affect things as far as investing and what we should be doing right now?
It affects things quite a bit. First off, I have to kind of give the disclaimers that the lawyers want me to talk about.
Okay.
So I'm going to be talking about a couple of different types of investments today, and it's important for everybody listening to understand that I'm not making any recommendations to buy or sell any investments. I'm going to be talking about possibly unfamiliar investments and concepts, and we're going to be talking kind of in generalities, not about specific programs. So you should always get the advice of a trusted financial advisor before buying and selling any investments. You should read the prospectus, no matter how boring it might seem, before you plunk down your dollars. And every investment has risks, including losing principal. So I hope that he keeps the attorneys at bay.
Sounds good to me.
Sounds good.
I feel like you're completely protected
Yes.
right now.
I hope so. I hope so. So your question about what happens with low interest rates?
Yeah.
Yeah. How's that affect investments?
Well, it's wonderful for people that want to borrow money.
Right.
So as you well know,
We
for
like that.
buying houses, yeah, it's wonderful. But it's a real challenge if you're trying to earn interest on your savings or typical investments like CDs and bonds and those sorts of things, or maybe even annuities. Interest rates being really low, you don't get very much yield on those things unless you take a whole bunch of risk.
Mm-hmm.
So if you're, and particularly if you're a senior citizen, this is an area that many of them really care about because that's kind of what they traditionally have used.
Right.
So
They're probably not too
Risky.
risky. Well, yeah, I mean, you don't want to be, right?
No.
yeah, they're very risk averse.
Right.
Exactly.
Typically, yeah.
That's what we call them.
Yeah. So yeah.
So where should investors put their money then before interest rates start to rise again? What's the good thing to do now in this situation?
Well, the challenge for most investors is that typically they have invested in stocks and bonds, and so they'll have some sort of ratio, and their advisor might say, well, you should 70% in stocks and 30% would be appropriate for you, or 60-40 split. Well, you're still only investing in stocks and bonds.
Right.
The challenge there is that stocks are at an all-time high, and the old adage is you always want to buy low and sell high, not buy high and then wait till the market crashes and then try to dump it.
Then get scared.
Yeah.
Right.
So here I am. I'm a stock and bond guy, and I'm really kind of nervous about recommending stocks. And then bonds have kind of a hidden problem that a lot of people are not aware of, where if you think of like a teeter-totter, when interest rates go up, one end of the teeter-totter goes up, bond values, what it says on your statement your bonds are worth, drops down.
Right.
So we've had 30 years now where interest rates have been falling, which is really wonderful because then your bonds are performing better than they really should be.
Right.
So everybody's, for 30 years, we remember that, hey, bonds seem to be working pretty well for us. Well, that's going to change. So, and the problem is it's not just, all right, interest rates go up 1%, my bonds drop 1%. It's a multiple.
Right.
Multiple.
It's not like a perfect science 1 for 1.
No. So what happens, the longer the bond is stretched out for, the worse the drop in performance. So if you had the safest thing in the world back in 2014, during the summer of 2014, they raised interest rates. They tried, and they did. And then what happened was the safest bonds in the world were U.S. government securities. They went down 14%.
Yikes.
Ouch.
And if you were only earning about 2% a year because they were so safe, and then suddenly you lost effectively 7 years of all of your earnings, just disappeared in a 3-month period of time, you probably had a couple of questions for your advisor, like, why did you put me in these things? I thought these were safe.
Right.
So that's what's going to happen coming up as interest rates go up.
Yep.
That's the sort of thing that's going to happen. And that's what I've been cautioning my clients about is like, hey, let's try to find something that acts like bonds. It gives you a nice consistent income, but isn't subject to that interest rate risk.
So what would that be? We're not going to do bonds. What are we going to do?
That's the big question. So there are several alternative types of investments that don't have that interest rate risk, but yet still give out kind of a consistent income and a much higher income than bonds typically have anyway. And that would be one of them is real estate investment trusts. So what happens there is the investor is putting money into a big pool, and they've invested that pool in a bunch of commercial buildings, and then the income coming in from the leases is what's giving you your return. So it's kind of like owning a rental, except that you never get any calls about, my toilet's backed up, and that kind of thing.
Yeah. Wow. So do you have to have a lot of money to get into that kind of investing then?
Typically, yes. It would take millions of dollars to buy a commercial building.
Right.
But in a real estate investment trust, if you qualify, and some of them have higher requirements than others, but you can put in a relatively reasonable amount of money and still get into something like that and still get the benefits of the buildings going up in value and the income spinning off of them going into your checking account every month.
So how do you find those? Those aren't on the Dow or whatever, right? Are those? Is that
It seems.
Or how do you find them?
Well,
Other than call you, right?
Well, that's the best way.
Yeah, that would
Obviously.
the easiest way to do it. But
the challenge is a lot of broker dealers aren't real excited about having their advisors recommending these things, and I'm not sure exactly why that is. I think some of it is that they're fearful that they're not going to be explained properly, that the advisor is going to make a recommendation without fully understanding that particular program, and then if it goes haywire, they're going to get sued, and everybody's afraid of that. So I think that you have to almost be a specialist in that area to be able to filter out the good ones and the bad ones.
And so you do that. That's what you do. That's one of the things you offer, right?
Yes, and the company that I work for, it sort of specializes in the alternative sphere. So here we are talking on alternative radio.
Yes.
Alternative talk radio, and
I
I'm
know.
a specialist in alternatives. So.
I like that.
I
That's
do.
a good
I like
bit.
it too.
Yeah.
So I'm just curious, though, why not just, the stock market versus bonds and this real estate, which obviously is maybe not recommended by every advisor, like you said. So what about the stock market?
The stock market has given very good returns over a long period of time. And so, depending on how you go back and do the math, 10% average, that's there's nothing wrong with that. But the problem has been is that every decade it's gotten a lot more volatile.
Right.
So if you measured the number of days where there was a 1% gain or loss in the S&P 500 back in the 40s, there might have been one day in the entire year.
Okay.
In the 50s and 60s, there might have been 3 or 4 days. I think last year there was something like 80 days that it did that. So it's a much more volatile, area to be playing in. It's a much more dangerous area to be playing in. There's a lot more professionals that are moving huge amounts of money because if they see a very, very small uptick or downtick, then they're moving a whole bunch of money and they're kind of affecting the prices a lot more.
Right.
And it makes it more volatile.
Right.
Plus, it's at an all-time high. So if you own some of that, you're pretty happy.
Mm-hmm.
But do we stick? If you sell a piece of property or have some money to throw in, do we throw it in now when it's high? I'm a little leery of that.
Right. Yeah,
So
makes sense.
I'm kind of curious because I do actually read a lot about investing in the stock market and stuff. And do you agree with this? What I've heard in a couple different books is like, obviously there's highs and lows, right? And you don't want to buy high and sell low. You don't. But if you continue to invest on a regular basis, then you're buying at all levels of the market. So it's, you're taking advantage of all the the dips and the highs. Do you?
Yes, absolutely. That's a technique that's known as dollar cost averaging.
Mm-hmm.
And it's a great way, and especially like with people investing in their 401ks,
Mm-hmm.
they're putting their money in the same amount of money every month, and it just goes in there. And if the market's high, you didn't buy very many shares. If the market was low, you bought more shares. So what happens is you kind of take advantage of the fluctuation instead of being victimized by it.
Right. It's probably pretty tricky, though. It's kind of,
It's no
it's
guarantee.
no
It's
guarantee. People you can't necessarily, I guess that's why I think from what I've read, it's sort of like you really can't time the market. Unless you're maybe Warren Buffett, I guess he can because he's done really well. But, just to be continually investing so that you are doing that rather than trying to, okay, this is a great time. Get in. Oh, get out. Get in. Get out.
Exactly.
So what about these commercial real estate investments that you're talking about? Can you give us an idea of like what sort of rate of return are you going to get on an investment like that versus the stock market?
I have to talk in generalities
Right.
here
Mm-hmm.
To keep the lawyers happy. So there are some that have worked out very, very well, and there are some that have not worked out well and people have lost money on. So, we need to know that.
Right.
But it can be, it's not unusual to buy into one of these real estate investment trusts, and they hold on to the investments, they buy the buildings, and they kick out maybe a 6% rate of return while you're waiting.
Okay.
That's from the earnings off of the leases and all of that. Then at the end, when they sell the buildings, hopefully they sell them for a higher amount than what they bought them for. And after all the expenses and everything, maybe they've got another 4% gain on that. So you add the 4 to the 6.
It's pretty good.
It can be pretty good.
Yeah.
I just had one that just liquidated, and it worked out great.
Wow.
They had about a 45% gain over what my investors originally put in, plus they'd been kicking out their distributions every month like clockwork. So,
wow. Well, it seems like a pretty safe investment with the market going the way it is. Real estate's going up.
It is. Now, it's a lot different than residential.
Yeah.
So,
Right.
So I know the focus of a lot of people when you say, what do you think about real estate? The first thing they think is, should I buy a rental house?
Yeah.
Right. Right.
You're not talking about that.
No.
You're talking about commercial buildings.
Right. You might be talking about a hospital. You might be talking about storage units. You might be talking about warehouses or, all sorts of different categories.
So is this something that you're doing more recently, or is this something that you have always done? I know historically real estate is kind of like the stock market. Over time it's been a good investment. It's definitely had its dips, but so is it something that's more prevalent now, or?
Well, what's interesting is the real estate investment trust, that's one category.
Mm-hmm.
I don't want to keep harping on the one thing, but we got a limited time here. But that one type of alternative investment has been around for about 30 years.
Okay.
So it's not a new thing. It's not a fad thing. It's just a thing that's out there that's available.
Right.
And when you take a look at the 1-year history versus what the stock market has done, the 5-year, the 10-year, the 15-year, all the way out to 30 years, in every one of those categories, in every one of those time frames, that's outperformed the stock market.
Wow.
So why wouldn't you consider it?
Mm-hmm.
And if you add those things into your investment portfolio, it does, since it doesn't act the same as stocks and bonds, it does diversify you better and can help prevent bigger losses.
I like that.
I like diversification.
I know.
Yay.
It sounds really, I like it. It
I
sounds
do
good.
too. I know. So what are things that you're advising clients right now that they should be wary of?
Well, interest rates going up.
Yeah.
That would be a very, very large thing. And I think that's I think
Is that
that's
really it?
I think that, yeah. So part of the problem, what we were talking about before the show started, is one of the things I really worry about is that people say, well, I don't really think I own any bonds.
Oh.
And they probably do.
Uh-huh.
And one of the biggest areas that they typically, my investors typically don't understand is what they've got in their work 401k.
Yep.
A lot of times they will just say, oh, at work they've got this thing that says if you're going to retire in 2030 or 2045, that's about when I think I'm going to retire, so I'll just choose that one, and then they're going to do the magic behind the scenes, and then I don't have to think about stuff. And that could very easily put them at 25 or 30 or even 45% of their portfolio could be in bonds that are in that highly risky area when interest rates go up.
Yeah.
And then they're going to complain and say, I had no idea. I thought these were the safe things. I thought it was the stock market that could go down that much, and it's too late at that point.
That's very true.
So, Gary, say someone, they have their company 401k, they have maybe, other investments, but they're interested. If they came to you, how does that work? Do you kind of look at what they have and then maybe try and help round it out for them? Or what would the client experience be with you?
Yes. We do a pretty deep dive. I ask an awful lot of questions. I've got forms I have to fill out for the broker-dealer to feel happy about placing the trades. But we have to kind of get an idea of where their current investments are, how much risk they feel comfortable with, what their time frame is for the investments. And sometimes for this specific investment, they might feel very cautious about, but on the other stuff that they've got, they may not feel anywhere near as nervous about.
Mm-hmm.
And so, we have to take all of that into consideration and say, okay, so for this money, what we would want to do is maybe, put 25% of it into some of these alternatives, REITs, business development corporations, commodities. I mean, there's a lot of different types of alternatives they could invest in.
Right.
That would give them the diversification, safety that we're looking for.
That's awesome.
Yeah, that's great.
Well, I think, we will have all the information on the website. So if you're interested, you can contact, get Gary's contact information there, and maybe check out a real estate investment trust as part of your portfolio.
I think
Could be a
I'm
good
gonna.
thing. I know. Thank you so much for tuning in to Financial Fitness Northwest. When we come back from the break, we will be chatting with Melissa Garrick from Vision House. To find out more about topics discussed on today's show, you can find us online at www.financialfitnessnw.com.